As we pivot to Europe, obviously things have continued to remain in their dire straits when we look at just pricing. But as we showed in the EIA show, electricity prices have come back down, and they always had a meteoric rise up and a collapse down. And when you look now going forward, what is the right price? And I think we're kind of going to fall somewhere in the middle, especially because when you look at the goal, and they've been trying to cut electricity demand, and there is a report that just came out saying that it's come down. So Europe natural gas demand destruction still trailing target, according to WoodMac. So I think this is important. Europe's natural gas demand over coming winter is seen 7% down from the past 5-year average as a result of high prices. But there's also the potential for even more demand destruction, as we've been talking about, as they try to force, again, not force, but companies either do it for economic reasons, or they're told, look, you can't produce more or run longer than this percentage because we just don't have the natural gas. So that then pivots back to people who are pointing to storage and saying everything's overblown. And which is, everything's always overblown to the upside and downside. But when you look at, okay, well, you can't really look at storage and say, well, storage is where it should be, therefore we're fine. It's like, well, storage is where it is because you've had glass facilities close, petchems cut runs or shutter, fertilizer companies cut runs, you've had refiners cut runs, you've had other industrial entities cut runs. So yes, you've storage is back, but what was the impact of the economy to achieve that? And who knows what Mother Nature will throw at us? And if you get a polar vortex, how quickly can that whittle down, and where would you replace it? So again, it's a very fluid situation. Now, obviously, it's going to be an unknown until we get into the winter and see what Mother Nature has in store. But can you maintain an economy with 70% of fertilizer capacity shuttered? I think it's up to 40 or 50% of petchem. That is not sustainable. So yes, you're okay for storage right now, but if you were to fire all those guys back on, how fast would that go away? And that's, I think, that disconnect in terms of, yes, it's not as bad as it was. Europe's not, people aren't running around screaming with hail and brimstone falling, but it's still not great either. And I think that's the balance that we need to strike of what comes next. So when you look at the Eurozone aggregate, economic confidence came in slightly worse at 97.6. Industrial confidence came in at 1.2. Service confidence came in at 8.7, with consumer confidence falling again to 24.9. So again, you're still seeing that slide. And one of the things that we've talked about is we see a bit of an acceleration in that as we get more pain from the perspective of the consumer and on the industrial front. So CPI continued to go up again. Global Eurozone manufacturing PMI was expected at 49.7, came in at 49.6. So again, still that contraction, which we see that pressure. But the ECB is facing 9% inflation and getting worse. So market pricing for the 2022 year and the ECB rate is now at 1.37%. As we've been saying, we assumed it was going to go to 2%. So again, we're making headway there. And as things continue to deteriorate, it's likely instead of it actually, because typically when things deteriorate on an economic level, you accelerate cuts. But because they were below zero up until March of this year, they have no, cut where? Where are you going to cut to? And that's where, again, we see this expansion and this movement higher. And the market is now pricing a rate hike of 65 basis points. Again, it's going to likely be anywhere between 50 and 75, just because they need to do something to try to adjust the inflation that they're seeing and the problems that remain. Excuse me. So now when we look at France, business confidence was expected at 101, came in at 103. Manufacturing confidence right at 104. Production outlook came in negative at -2, better than the estimate in last month. And then own company production outlook came in at 13. Consumer confidence at 82. So things were a bit better in France. And again, it's nothing is going to happen all at once. And that's why France is doing a bit better. There's a little bit of expansion. Manufacturing PMI was expected at 49, came in at 50.6. Consumer spending, though, slowed. CPI leveled off. So it's kind of a mixed bag, but that mixed bag is coming into essentially a matter of stable. It's not contracting. It's not going down. It's not going up. It's just kind of flat. So because it's not going to carry Germany and Italy and Spain, it's just going to stay sideways. That's why we talk so much about where is Germany, what are the issues they're seeing, and how is that going to impact. And then you look at what the ECB is doing, and they're going to be forced to raise rates, which is going to put more downward pressure. And again, not so much send France, spiraling, but it's going to keep pressure on them. But it will send other places spiraling, and that's why we talk so much about those ancillary, or what used to be, for those that have been in the industry long enough, PIGS: Portugal, Ireland, Italy, Greece, and Spain. Obviously, they're slightly different, but Greece, Spain, and Italy are still big issues as we're looking at this holistically. So then when you look at Eurozone industrial confidence, was expected at 2.4, came in at 1.2. We do see this going negative. Eurozone services confidence was expected at 8.8, came in at 8.7. Once, we do see industrial confidence going negative, but kind of flatlining. And we think services is going to catch up, because that's really the last shoe to drop. And does it happen in September or October? Again, that's kind of a coin toss in terms of, because the consumers, as we know, is very fickle, and within the Eurozone, they're throwing out inflation checks, they're increasing government subsidies, so they're trying to do what they can to maintain, spending to some degree, which again is going to cap some of those adjustments. Eurozone economic sentiment was expected at 98, came in at 97.6. So again, moving lower, and that's going to be under pressure with German CPI expected at 8.8, coming in at 8.8, again breaking to the new highs, keeping the pressure on Germany, the largest economy, therefore again really driving down that Eurozone economic sentiment further. Italy, when you look at consumer confidence, was expected at 92.5, came in at 98.3. Manufacturing confidence right in line at 104.3. Economic sentiment right in line with 109.4. Industrial sales month over month coming down a bit. CPI, though, accelerated, was expected at 8.2, came in at 9%. Month over month was expected at 0, came in at 0.8. So that's where we get the pivot. And that's what we think is going to, again, drive down some of that confidence. And you're seeing it in manufacturing. PMI was expected at 48.1, came in at 48. So again, that downward move still remains when you look at they're in contraction while inflation's going up. And again, that's why we think Italy is going to come under more pressure. They still have their political uncertainties. And now you're getting that debt push. And as ECB raises rates, and based on the debt profile of Italy, they're going to come under more pressure than others, which is going to throw into question the anti-fragmentation tool in terms of the balancing act that the ECB is going to try to maintain rates. Eurozone CPI, that acceleration was expected at 9%, came in at 9.1, but core, which was expected at 4.1, came in at 4.3. So again, you got that re-acceleration in August that we talked about, and given where things are going forward, we expect some of that to come through in September. Obviously, electricity prices have fallen, natural gas prices have fallen, so it won't be as ugly. But how quickly were companies able to pass through their costs to their consumers? And the answer is they were so shocked in August that there was no time to raise prices. So now you're going to have prices getting raised gradually, or at least less than what they paid in August. So that's, again, going to be a backstop and a tailwind for CPI, because they're going to try to pass through this price. I'm sure everyone saw those pictures of electricity bills and the shocking nature of it. Well, that's going to show up in your muffin, your coffee, your shirt, your pants, socks, shoes, whatever. That's going to continue to keep that, because they're going to try to recoup what they spent in August and what they're going to continue to spend going forward. France real goods expenditures obviously moving down. Again, adjusting for inflation, you're getting that move lower. Again, volume versus value. Volume continues to move down. Consumer spending on transport equipment moving lower. Consumer spending on household durables flatlining but starting to pivot down, and we think that pivot again accelerates. CPI, you can see a bit of a pause, expected at 6.7, came in at 6.5, but the reacceleration in Italy. And again, that you're still seeing the movement up. It's not going to be all at once because they all have individual drivers, but you can see where that expectation is going higher, which is why the rate index futures continues to push up in for the ECB, and you can see how from even a week ago the whole curve is shifted up because the ECB is so far behind. The market's starting to price in them getting more aggressive. PMI versus real M1, or again, as the ECB tightens, it's going to draw down liquidity, draw down the float. And again, that's going to put more pressure on manufacturing, more pressure to the downside, which is why we think there is more pain to come in September. Goods and services exports are set to fall again when you look at exports. So views of their competitiveness outside of the EU has cratered. Obviously, a weaker euro is going to help, but you can see that, again, the downside still exists when you look at Q3 because, again, China is not importing enough. The Eurozone has been relying more and more on China. And again, that continues to go down fall by the wayside. German consumer confidence was expected at negative 32, came in at negative 36.5. Willingness to buy cratered to negative 15.7. Again, the German side is where we see a lot of this degradation, which is going to reverberate through the rest of the European Union, the rest of the European zone in general. And again, that's going to be some of those additional headwinds. Margins. So the margin change, the Eurozone EBITDA margin, again, all of this is showing just the slowdown, firm competitive position versus change. All of this is just showing additional margin compression, which we don't think has been priced fully into the market. German business expectations was expected at 79, but again, just kind of flatlined. It's not that it improved, it's just it didn't continue to go down. But given the bills that they've received in August and what September looks like, we do see that acceleration, which is why we see GDP going negative as we progress. And then just looking going forward, because I think it's now important because you had some flatlining on current business situation, but look at expectations. Expectations continue to be negative, continue to decline or flatline, which we think will accelerate to the downside. Again, putting more pressure on the European Union in general. And again, more what we think is going to be write-downs and earnings adjustments at the corporate level, as well as consumer level, as we continue to see expectations get diminished, which just means that guidance isn't going to be what I think the market is expecting. So that's what we have for you in Europe. In the next segment, we're going to go deeper into China and other India and ASEAN nations.